Introduce myself. My name is Yasmina Davaniza, and I'm an investor at Roundhill Ventures, a PropTech VC firm investing in early stage businesses reshaping the built environment through technology. So I started the VC Lead Ladies educational series last year to encourage female investors to exchange insights, develop meaningful connections, and lean in and help each other move up in a fairly male-dominated industry. And for all the male attendees here today, welcome. It's a pleasure to upskill together. Now, without further ado, I would like to introduce the first part of our session, the wonderful Michaela Brady, Vice President at Silicon Valley Bank, specialist in providing banking solutions and debt finance to growth stage fintech companies throughout Europe. Michaela will be giving us the Venture Debt 101 lowdown to educate all the noobs before we have a more detailed panel session at around 9:30. Remember to post any questions you have in the Q&A tab. Michaela, please take it away.
Thanks, Yasmina. Thank you so much for organizing this and for Roundhill Ventures for hosting. Really excited to be a part of it, to be able to share on venture debt. I'm just going to share my screen with a presentation just on venture debt itself. And let me know if you guys can't see it.
Looks good.
Okay. So as Yasmina said, I work for SVB in our venture and growth space. I work specifically with our fintech companies doing debt solutions, whether that be via venture debt loans, lines of credit, or larger facilities. SVB, if you aren't familiar with us, is a global bank. So we started in the US, fortuitously named Silicon Valley Bank. We have offices across the US. We also have an office in Canada, here in London, Ireland, Israel, Germany. We have boots on the ground in Denmark, and then we also have an SPV in China. So we have a really good kind of coverage of the innovation economy, which is really where we play. And that ranges from capital call lines for funds to private bank in the US for C-suite executives, founders, investors. We have a premium wine industry in the US, and then we have our bread and butter, which is the corporate banking, which is where I sit, doing the venture and growth lending. So what is venture debt? I think a lot of you are probably familiar with just the traditional high street bank lending model, which is typically cash flow dependent loans. So if we look at this slide, this is really what SVB offers to the market, but we can use it as kind of a breakdown of different debt opportunities and think about it in terms of repayment source. So on the far right, you have the more traditional style lending, which is the cash flow. So corporate finance, buyout, that's companies that have scaled revenue, they have sustainable cash flow and can use that to repay a loan. As you bring it back a little bit further, you may have a company that's cash flow break even very early on in its cash flow. It hasn't really sustained it yet. For those companies, credit lines that are asset backed, something like an accounts receivable line of credit where you can use the collateral to repay the loan, or a mezzanine loan where you're looking at an exit or flipping to cash flow and later refinancing it, are really great options. As you come even further back though into that negative cash flow space, which is where so many of our companies sit, because they are early on in their revenue or they're scaling a lot year over year, but in order to do that, they have to burn a lot of cash. That's really where we really sit on the venture debt side. Growth loans are very similar to venture debt loans. They can sometimes involve a little bit more structure, which we can get into. But really think about venture debt loans as loans that are made to companies backed by institutional venture capitalists or like sources. It really doesn't include friends and family style money or those style investments, because typically you haven't hit a traction point. And really what it comes down to is repayment source. So on the far right, you have cash flow, maybe you have some sort of collateral. For venture debt and these earlier stage loans where there is still a cash burn profile and probably not those receivables or something to collect on, we're really focused on future equity as our repayment source. And that's where you as a VC come in a huge kind of play, where before we even issue a term sheet, we're going to have a conversation with you guys and see how are you thinking about the deal, what made you invest in this company versus other players in this space, how are you thinking about milestones to that next equity round? And we'll get into how we structure this, but those are really the questions that we'll connect with a VC on ahead of time, because core to the venture debt is the idea that we're getting to that next inflection point to raise that next round of equity. A lot of times venture debt loans don't even make it to maturity because it's so common for a company to raise a chunk of capital, layer venture debt on top of that. It helps them get to that next inflection point, and then they raise another round and we do a refinance or a restructure. So use cases, how are you really using the venture debt? There's a few different ways. You can extend runway to the next equity round, invest in product development and insurance policy, geographic expansion, product testing, CapEx, building a bridge to profitability. The number one use case we typically see is extending cash runway, and that kind of overlays all of these. And inherent in all of these from the VC side is just the question of why are you bringing on venture debt instead of just utilizing the equity that you have, because you are going to be paying for the venture debt, or your company is going to be paying. Really what it comes down to is cost of capital. Venture debt is a lot cheaper than equity. So think of it as a tool in your toolkit, where if you're a company that is raising a $10 million round, and for simple math, let's say that you're burning $1 million a month, it gives you 10 months runway. If you need 12 months to get to that user number or revenue number, whatever it is that you want to raise your next round off of, if you can get venture debt that gives you another 3 or 6 months of runway, you then have the time to scale and hit that and have a better outcome in your next round than if you had pursued it with equity alone. And it's a cheaper, less dilutive option for the founders as well as the existing shareholders on the cap table. Underscoring all of these use cases is also just a question of time and when is it the right time to bring on venture debt. As a VC, I would encourage you all to have your companies consider venture debt when they're pursuing the fundraising. The reason for that is sort of the umbrella shopping analogy. It's better to pursue venture debt when you don't need it. When a company is low on liquidity and it is also cash burning, the risk profile is that much greater. And so doing a venture debt loan at that point in time is a lot trickier, and typically it's going to be less advantageous for the company on just a pure terms basis. The way to really bring it on is early, and then we can get into the structuring on this next slide. But really there's kind of 3 key elements. So it's the structure, the collateral, and the pricing. On the structure, that's covenants, collateral. We talked about receivables, for like a line of credit or cash flow, for a cash flow dependent loan, and then price. So if we think about that timing on the structure, what we can do is we can say there's a longer draw period. So you have time to draw those funds. You don't have to do it right when the loan closes. For structure, this slide's slightly misleading with the covenants. For venture debt, just know that there really shouldn't be covenants on the facility. What you might see on the structure side is some sort of milestone. And so what a lot of lenders do is we say a portion of this is available at close, and then a portion is available upon hitting some sort of milestone. And again, going back to those conversations early and often with investors, we want to gauge with you what the right milestones are and align with how we're looking at these companies. And thinking about those use cases, we want it to be a clear use of the funds. So even if it's just saving it for a rainy day, having that understanding and knowing, if revenue isn't tracking a plan, that might be when the debt gets used, and really structuring around that so the debt is available when it needs to be is really important. Also, you don't want to over-lever a business. So if we're looking at the venture debt and we're saying 3 million is the right number overall, is that based off of today, or is it based off the scale we see within the business? And on that basis, do we want to make a portion available now? If the company is tracking to plan, we can release more debt and help them hit that next round. Otherwise, if they're not tracking a plan, is putting more debt on the balance sheet actually counterintuitive, because a new investor coming in may look at a company that hasn't scaled to where we all thought it would and think, am I putting in 5 million and 3 of it's going to go to pay back a debt facility? These are all things we think through and we're really mindful of when we're structuring this debt. That way we're not over levering a business and we're not being a prohibitor to raising another round, and that we're really additive to the growth story. On collateral, again, you're not going to have receivables or cash flow on these loans, but what you will have is IP. So you're going to see that the bank takes a lien on IP, as will any other lender in the space. If you have a US-based company, a lot of times you'll see what's called a negative pledge on IP. That just means that the lender isn't taking a lien, but no one else is allowed to take a lien either. The reason we use IP, it's obviously a tricky spot because for founders, that is their baby is the IP. But what it really comes down to is in the absolute worst case, that's where the value of the business lies. We as an institution always work, as hard as we can to avoid situations like that. And as you and your companies are pursuing any venture debt option, you should definitely do due diligence on whoever you're going to be working with and see what their track record is. Obviously, being in the middle of a global pandemic isn't great, but it does give a lot of good insight into how lenders are reacting right now to tough circumstances. So use that to your advantage in assessing who you want to be your partner moving forward. And you can just do that by seeing how the lender behaved when everything went down here. Some lenders also have gone through the dot-com, the 08-09 crisis. And so you can see a lot of trends and how they've reacted over time and be able to use that in analyzing who you want to work with. And then the third thing is price. So price is something that can be a sore spot on debt facilities. The thing to know is that with earlier stage deals, we're not going to have a lot of structure outside of those milestones. And there's not really a lot of collateral because we don't have something that we can truly take in to repay the debt if something goes wrong. So they're typically priced a little bit higher. What we can get into is kind of the key terms on these facilities where pricing comes more into play. So you have your type of facility, the amount, the cost, and the covenants. Let's just start on cost first on that kind of line. So the upfront fee, the back end fee, the interest rate, those are all pretty standard across the market. You may see slightly different rates depending on who the lender is. Just because there's different sources of capital on the lender side, and that's going to impact the rate of return that they need to see. Whenever you're looking at a deal, consider all of the fees together. If you just look at one fee, it may be slightly misleading in how you're considering it. This is also where VC can be a lot of help to a company because you're going to see companies across your portfolio pursuing debt opportunities. And if you see companies at similar stages or similar revenue traction getting vastly different terms, definitely speak up and say, I saw so-and-so get better terms, whether that means you introduce them to that person or you have a conversation with the lender. There's always going to be a rationale behind it. And so who's ever doing the debt probably has a solid reason for it, but they can walk you through it. And then this last point is warrant coverage. So this is very specific to venture loans, and you've probably seen it if you've been involved in any of these. Warrant coverage basically is a mix of pricing and structure to an extent. Because we don't have structure on these facilities, we don't have covenants, the repayment sources, the future equity, warrants give the lender an opportunity to participate in the upside. The warrant coverage can be shown as either coverage, so what does this mean as a percentage of the actual loan commitment, and fully diluted ownership. So if we look at this company's cap table, what does this mean on an ownership basis? Lenders use the two interchangeably, but they do mean different things because one is based on the commitment, one is based on the cap table. So if you're looking across a few term sheets and you're trying to give advice to anyone of your companies, keep that in mind and just say, apples to apples, are we looking at warrant coverage? Are we looking at fully diluted ownership, and try to bring it onto the same playing field? The way that these get recognized changes, and it's often market driven. So in some markets, you'll see that warrants are recognized fully upfront. That's very common in the US. In other markets, it's more common to see, and largely here in the UK, a large portion is recognized upfront. And then if you have a tranche facility, you may recognize portions of the warrant with each tranche once, the facility earns into those tranches or milestones. And the way that the warrants work is really compensating for the risk. If you think about the risk of a venture debt loan, and again, thinking about those repayment sources, it's a lot riskier than standard style lending. And that's why there's not a ton of players that do it. The warrant allows us to compensate for that risk, participate in the upside without burdening the company with an upfront cash cost, which just wouldn't make sense at this stage of a business's life cycle to pay. Moving up to type of facility, so amortizing term debt, this is typically what you're going to see on a venture debt loan. You're going to have some sort of interest-only period that might align with the draw period. So like we talked about, you could draw a portion at close, or you may have a draw period of 12 months, 9 months, because you don't need that debt right away. Typically, these facilities are about 4 years in total length. As you get into later stages, the growth stage, those mezzanine style loans, you may see a longer facility, and maybe there's a bullet repayment at the end. But when you're looking at venture debt on this early stage, you're going to see some sort of 6, 9, 12-month interest only period, followed by an amortization period. The amortization period is typically equal monthly principal payments. And then again, as you think about this, just look at the market, see how lenders have reacted during this downturn, and just see, how have they been additive to a company's journey? Because times like this are really when we test out how lenders work with companies through hard times. And so just keep that in mind. On the amount, which ties very closely into the type of facility, you should rule of thumb kind of 25-30% of the most recent equity round is what the total debt quantum should be. So let's say it was the 10 million round, maybe it's 3 million. That might still be tranched. So it might be that $1.5 million is available at close and $1.5 million available on some sort of milestone. If you have a company that raised equity and then is waiting to raise the venture debt, we don't want to wait too long, because again, it's harder to structure these deals the longer we wait and the tighter the liquidity profile becomes. But you do want to consider that we'll look at cash on balance sheet in that case versus necessarily the most recent equity raise, because cash on balance sheet is like the true liquidity of the business and what we're looking at for cash runway. Generally, when I look at a deal, I want to see 12 to 18 months of runway with the business when I'm structuring something, because that means that we're, giving them a solid footing above what they already have. And it truly is that runway extension, or helping to pursue those other opportunities, whether it be geographic expansion or product expansion, and do that quickly and agilely versus doing some sort of a bridge loan to another equity round, which again comes at a much higher cost, and generally a lot of lenders shy away from that. On covenants, so again, you don't want to see covenants on these venture debt facilities. The milestones that I spoke about are not covenants. They would not be an event of default if a company doesn't hit them. Again, it's really to align with the use case of the debt and why the company is going to be deploying that capital. And if they're not tracking to plan, again, it probably doesn't make sense to put more debt in to a company. The better solution is to do some sort of interim equity round where the investors step up and help out to get to that next round, or potentially you look at raising earlier based off of whatever metric the company has hit. So on the warrant piece and on the pricing piece, why do you want your businesses to bring on the debt versus just pure equity? So again, this is just going back to it's less dilutive overall. And so it's really a tool in the toolkit. It's a tool for investors to use as well. And as you're thinking about, if you've been a part of the Series A, a company is looking at a Series B, can you use debt as a part of the Series B solution? So using that 10 million number, instead of raising 10, do you raise 7 and bring on 3 of venture debt? Is there a way that you can partner with the lender to get to the total debt number that you need on a less dilutive basis? This chart just shows the total cash cost and the total equity dilution, and it's a nice kind of visual of the benefits of venture debt on that basis. And then to kind of just underscore everything, why use debt, how to use it, there's kind of 3 main pitfalls, I would say. One is taking on too much debt. So again, we talked about over-levering a business. Just be mindful with all of your companies how much debt you're encouraging them to take on. Your lender is likely going to talk to you about what the right debt quantum is, and making sure that, again, the debt is additive to the business and helping them get to that next inflection point. Two is not waiting too long. So again, make sure that you're bringing on venture debt at the right time. I've had a number of businesses that, we talk to early and then it just doesn't feel like the right time. And unfortunately, a global pandemic is a good example of this, where, a company waited and now there's a lot going on, and having that debt on the balance sheet would have been a really great use case to help buffer cash during an uncertain period of time. And then third is just making sure that you're not using it as an equity replacement. So you really want to use the debt to bring your company forward versus saying, again, that bridge style loan, you don't want to use debt as an equity replacement. It really is additive to the solution. It's a tool versus the kind of sole option. And then just to close out, things to be mindful of. So I've mentioned it a few times, but your venture debt really shouldn't have covenants. If you see covenants, definitely push back on behalf of your company. Businesses who are pursuing venture debt are too early in their life cycle to sign up to covenants. They're typically, working off of plans that are early and they haven't hit that scale where they're able to concretely say that they're going to hit those numbers. And so you need a lender who's flexible and able to move on that stuff. And so make sure it's free of covenants, because you don't want a situation where a company is in default on anything. Security. So again, this just goes back to IP. That's typically what you're going to see on these facilities, because you're not going to have something like cash flow. You're not going to have something like a receivable to collect on. No personal guarantees. Excuse me. Personal guarantees come up sometimes. I would generally recommend against them. I don't structure deals with personal guarantees where, the founder is making a guarantee against the deal. You may see them from some more traditional banks or very early stage, but generally we recommend against them. Really, if we're putting debt in, we're underwriting to that future equity, and we're underwriting to, our belief in you as an investor and how you've earmarked this, and we don't need that personal guarantee from a founder or an investor. Make whole interest payments. So I talked earlier about how the facilities are structured cost-wise. One thing that can kind of be buried within the terms that you should just be mindful of when looking at a term sheet, there's going to be an early termination fee typically associated with these, because there's a cost of capital on the lender side whenever they're making these loans. One thing to be mindful of is, does that early termination fee also include make whole interest payments? Which means on top of that cancellation fee, there's also the charge of all of the interest through the life of the loan, even though the loan hasn't been active the full time. So that's something to be mindful of. We don't structure that from our side, but it's something we see across term sheets that can get overlooked. And that can make it difficult to leave the lender, even if there's another option available for you down the line. As the company scales, it makes more sense. Fully diluted ownership and warrant coverage, that's the item I talked about earlier, and just making sure you're looking at apples to apples. Warrant coverage is based on the commitment amount. Fully diluted ownership is looking at the cap table, and that really changes company to company because each cap table is so different. But really use that engaging, between term sheets, what the terms are overall, and taking a full picture of the cost. Ability to reprice warrants in a downside. So again, this might not come out in the term sheet, but it's something that you can just explore. It's just what the terms of the warrant are, should there be a downside, and whether or not the lender can reprice them. Use a lawyer that is familiar with these types of facilities, more relevant for your companies, but something, again, just to be mindful of. I've had a lot of experience where companies use internal counsel, which is great on their side for conserving cost and not putting a ton of cash that they want to hold on to into legal fees. What it does do, though, is it puts more of the pressure on our counsel to typically explain how the facilities work and the different concepts, versus going out to an external counsel and using them who is more familiar with these facilities. Generally, the cost is lower overall when there's an external counsel involved, just because they've seen so many of these and they know how to negotiate, they know what to negotiate. No board seat or observer seat. We don't take one as a lender. We don't expect one. Kind of reflecting back on the warrant coverage, fully diluted ownership, one question that typically comes up is preferred or common stock we're happy to take either. We don't really pursue the benefits that comes with being a preferred lender. And so we're not really looking for preferred stock in that way, and we can adjust how we price it off of either common or preferred, depending on what the preference is. And then again, assess the full cost. So there's a lot of fees involved. Just think about them in their totality, because if you look at them again in silo, it can be a little bit misleading on the overall debt. And that's really it in a nutshell for venture debt. As a venture capitalist, you guys can be super additive to this process. Again, the lenders are going to reach out to you, gauge your opinion on things. We're going to use you as a partner throughout the course of the loan. And we really do see you as kind of part of our solution in figuring out the best options for the business, and expect frequent conversations. With COVID just happening, we had, debrief calls with all of our venture capitalists to see how are things looking for your portfolio, what businesses do we need to step up for that are on your kind of periphery right now, are there any businesses that you want to push really hard on, and you need our support to do that early because we have the capital to deploy. What is it that we can do to help you? And really just use the lender as a partner as you kind of look at the overall solutions for the business. And then I would just encourage transparency. We'll try to do whatever we can to help the business and again, be a part of that growth story. The more information we have to our advantage, the better we can be at being really quick to help and make decisions. And all of that comes from a transparent partner relationship with both the company and the VC involved. And that's really it. So Yasmina, I'll pass it back over to you.
Thank you so much for that. That was so informative. Great question from Eliza. What are the covenants that you might see from some lenders? Can you elaborate on covenants generally?
Yeah, so again, covenants are something you're going to see later on in the growth cycle of a business. For some of my later stage deals, my covenants can include a revenue covenant. If it is a business that has a more recurring subscription base, maybe we're looking at ARR, and we're just making sure that they're scaling that, month over month, quarter over quarter, whatever that metric may be. As we get into, on that chart, you have like the cash negative, cash burning companies getting into break even and then cash flow positive. If you have a business that's later in its life, maybe they're not thinking about raising more equity, but they're not able to get a cash flow term loan, do we do some sort of facility that tracks them towards positive EBITDA and really gets them to that break even point, with the understanding again in kind of consultation with the investor that should they not hit that inflection point, is there still appetite to invest in this business? Because again, if they can't hit break even and the ultimate story isn't going to be a cash flow loan, then they will need more equity, and it kind of falls back into that venture space. But then you wouldn't see warrants on those deals, so just keep that in mind too. If you see covenants on the later stage deals, you really shouldn't see the warrants.
Okay, noted. Bang on the money, 9:30. Thank you for being so good with time. So now it's my pleasure to introduce two more phenomenal investors and experts to join Michaela. We've got Daniel Bull, investment manager at Columbia Lake Partners, and we've also got Luke Smith, investor at Forward Partners, to talk about the newly launched Forward Advances product. So we've lined up all three speakers to give you a broader view on debt products along a startup's life cycle, from seed stage with Forward Advances through to debt servicing typically Series A startups with Silicon Valley Bank, up to growth stage companies with Columbia Lake Partners. So, starting panel, let's start with brief introductions for our new speakers. Daniel?
Sure. So Daniel Bull, investment director at Columbia Lake Partners. I joined 2.5 years ago after moving over from San Francisco, where I was doing this type of investing for about 5 years.
Thank you. And Luke?
Hi, I'm Luke Smith. I'm with Forward Partners, been with the team kind of 3.5 years or so now. Main role is investor, so sourcing and executing deals, working with portfolio companies. But we recently launched Forward Advances, and I was very involved in getting that off the ground.
Great. And just to make it easier for the attendees, in order from later stage to earlier stage, so Columbia, SVB, and Forward, can you tell us about your companies and their unique selling points, covering, for example, differences between your companies and the others here?
Yeah, sure. So just to start, a bit of background. So CLP invests in high growth tech companies. Got our initial start 5 years ago. Fast forward to today, we've funded about almost 50 companies, investing out of our second fund now. Quick USP on us. So we got our original backing from the partners at Bessemer Venture Partners out of the States. Our founding partner, Craig, came over from Canada. Then he started to recruit folks like my colleague George and myself out of the States as well. So we like to think we bring a bit of a kind of North American view to investing here in Europe. And as well as companies scale out here in Europe and they look to go to the US, we want to and we can be a part of how you think about going into the US and making introductions there as well.
Michaela?
Yeah, on the bank side, so we kind of go from the early stage. So we have a really great early stage team that brings companies pre-revenue, seed stage to the banking side of things, which we can offer throughout a company's lifespan. And then we really scale up on the debt options over time. So that chart I showed early on in the presentation, we do everything from the venture debt lending through to 20 million size mezz loans. We're closing recently on 10, 15 million loans for companies. And then we also do the larger syndicated facilities with a full syndications team, as well as a corporate and sponsor buyout team that really handle all the cash flow loans. So the benefit on the banking side is being able to have a full trajectory and a lot of flexibility in the options available to a company for the debt side of things, as well as kind of having that global focus of being able to either set up really quickly accounts in another country or have a partner bank in that area that we know well that we can leverage to help a company enter into that space. As well as similar to Daniel, definitely the US angle is super helpful too with just forging connections with VCs in San Francisco and elsewhere and really being a bridge for the network.
Luke?
Cool, yeah. So quite different. So quickly, Forward Partners, we're pre-seed and seed stage VC investing in e-commerce marketplaces and applied AI. Have a studio team to provide hands-on support for the companies we invest in. But investing in e-commerce and marketplaces, we've seen the challenge of a lot of the companies we're investing in end up spending a lot of the cash we're putting in on customer acquisition. And so we launched Forward Advances right at the back end of last year to really solve that problem. And so Forward Advances offers what we call growth capital. And effectively, it's cash for growth and particularly performance marketing, but it can be broader than that. And in return, we ask for a fee, which is a flat percentage of the amount advanced. So typically 6%, it can be a little bit higher. And then we take repayment as a percentage of revenues and typically over a period of about 6 months. So the advantages are we don't ask for any kind of control of the business. We don't have to ask for equity. And the repayments are set as a percentage of revenue. So there's no fixed cash repayments if a company hits difficult times to push them under. But obviously the payment time is a lot quicker, so we're getting our money back considerably faster than an SVB or a Columbia Lake.
What kind of time frame are you talking about?
So typically around 6 months.
I see. And then for all three of you, you've kind of touched on your typical product and who it's best suited to, but are there any specific pros and cons that founders of startups should think about when tossing up between the options?
Yeah, so I guess for us, our typical product is a 3-year amortizing loan. So this is something that's used to drive growth for 6 to 12 months time. So really helping you to scale your so that you can go out and you can raise your next round at a higher valuation. So what are the pros? The pros, which Michaela had touched on, it's less dilutive than if you only use equity in your fundraising life cycle. What are the cons? It amortizes, right? So it adds burn, it adds to your burn. But the important thing to think about is what you're using the capital for. So if you have an idea of an ARR level you're trying to get to for your next round of financing, you really want to build your debt structure around getting to that with a little bit of a buffer as well. So it's a longer term facility, so 3 years amortizing versus SVB might have something that is a line of credit that would be 12 or 18 months, and Forward Advances, as Luke just said, it'll be a 6-month maturity.
Yeah, so from our side, on the venture side, it'll be more typical to what CLP was talking about, where it's some sort of amortizing term loan. So again, you're going to have that interest-only period followed by an amortization period. You're not, on our side, you typically won't see that go beyond 48 months, but it's typically going to be closer on the earlier stage to 3 years. And then as we get into that growth stage where you have a company that's hit more revenue traction, that's where lines of credit come into play. I don't recommend lines of credit for really early stage businesses, because if you just think about sources and uses, lines of credit should really be used for working capital purposes. Typically early on in a business's life cycle, there isn't that kind of prudence and school of thought of just managing where the capital is going. And so sometimes it's used to fund burn, and it's not really a great use of that capital. Although it is cheaper, so as a company scales, it's a great option. One of the things I think just one of the cons of venture debt, or one of the things to be mindful of, I went through kind of the use cases in the presentation. If a company doesn't have a solid use case for the debt, don't recommend taking it on, which is counterintuitive to selling the product. But at the end of the day, having debt on a balance sheet where there is absolutely no need for it, but maybe a company drew on it, can be quite draining, because you're paying out that interest, you paid all those cash costs, but you're not seeing the benefit. So really do think through the use cases. If you have a business, for instance, I have one in the insurtech space that had a ton of liquidity closed around, but they did want to bring on venture debt because they realized that there was a few partnership opportunities that if they came up would require the capital. So that was a great use case for them, where they didn't need it, but they took it on as part of that optionality and flexibility down the line. But we scheduled a kind of long draw period. And so there's ways that you can work with a lender, but if you don't have some of those use cases earmarked, I don't recommend bringing venture debt on, because it can become burdensome to a business.
Yeah, and I think for Forward Advances, the real advantages are the speed and the ease of getting the capital. So I think the quickest we've ever gotten to an agreement was 3 days from the first meeting. So where it works really well is for companies that know they're onto something, you know, their unit economics are working, and the ad spend is working, and they need more cash to be able to pump into the marketing and grow faster. And so something like that, where you can get access to the capital very quickly and start deploying it fast and not be taking too much risk, because ultimately you're paying back as a share of your revenue. So you know you're not going to give yourself adverse cash flow from it. That's where it works really well. I think where it doesn't work so well is where you're trying to extend around, because ultimately the repayment time is so quick that it actually is cash negative. You know, if it's only giving you a few months, it's you're probably better off not taking it and just focusing on whatever you need to do to get something that will give you a longer runway.
That makes sense. Good points. So Luke touched on this already with his impressive 3 days, but what does the process typically look like for you? How long does it take? What kind of due diligence goes into a deal for you? How do you underwrite your risk?
Yeah, ours is a little bit longer than 3 days. We typically, from first meeting a company to maybe closing and funding, typically say that process is about 6 to 8 weeks. So the first 2 to 3 weeks of that process will be us gathering initial diligence materials and working toward getting in front of our IC and deciding if we want to issue a term sheet or not. And then the kind of following 4 to 5 weeks is a confirmatory diligence and legals. And so what is that confirmatory diligence? We call it an equity-like approach. So we'll go into a large data room, kind of the same information that companies will already have if they've raised an institutional round of equity. We'll call some customers. We're speaking with you guys, speaking with all of the investors, and then just as you would, you know, writing a big 30-page memo, representing that to our investment committee. And then the last bit was underwriting risk. What are we typically looking for? As I said before, we're looking for what is the milestone that we're getting the company to. So typically that's another round of financing. And most boards will have an idea in mind around, we want to be at this level with a range of this amount of growth. And so we're trying to build a structure for you that gets you there, and it gets you there with some leeway should that take 1, 2, 3, 4 months more. So we'll look at that. We'll make sure we're structuring into that correctly. And then the other bit, Michaela touched on this earlier, it's who the members of the board are. So it's who we're working with. That's really important. We're getting into a not as long as an equity relationship would be, so 10 years with the company, but 3 years, so kind of short midterm. And so it's really important for us to know who the members are around the board that are going to be providing that good governance and really guiding the company. So we'll look at that as well.
Yeah, it's a similar timeline from our side as well. A lot of it is company dependent. So getting the diligence and getting to a term sheet stage is typically dependent on how quickly we're getting the diligence in. Are we able to have those phone calls to run through what the business model looks like? And it can differ based on the sector that you're in. So whether it be consumer or enterprise or fintech, and that's just because regulations, the intricacies of the business models change based on the sector. So it can vary if you're looking across different sectors. And then from a legal process, I'd say the earliest for us from signed term sheet through to having closed legal docs, we have for our early stage deals a non-negotiable form that I'd say can take about a week to close on. That's the kind of fastest it's been for me. But otherwise, for typically 5 million plus loans, you're looking at, I'd say, like a month of legal negotiations. And that's really because you have lawyers on both sides just going back and forth at the end of the day. And I think Daniel will agree with this, we try to do a lot of work on the business side just to have side conversations and agree to business points, and then let the lawyers kind of do their thing and motivate and push timelines as much as we can. But that's typically where the process can get kind of stuck and locked up, is the legal process.
Yeah, and I touched on the kind of speed of our process earlier. Because we have much shorter repayment periods, the kind of level of risk we're taking is lower, and that means we can get away with a bit lower in terms of diligence. And so, yeah, we'll typically have a call with the management, understand the business, and then the key thing for us is getting access to some of the key data platforms the business runs on. So we'll ask to connect to Xero, we'll connect to the Shopify or the Stripe or PayPal, whichever payments platform they're using, and also typically their Google and Facebook accounts, so we can see the ad spend, as well as the kind of the more standard things like the financials and accounts. And basically from that, we can go away and make a decision in a handful of days. And what can slow it down is if there are some uncertainties and we've got to go back and forth and such like, but it means we can move pretty quickly.
Good stuff. So taking a step back, how is venture debt different in Europe? So in the US, I think maybe 2/3 of businesses are venture debt backed, while it's significantly lower in Europe. So why do you think that is, and how do you expect it to change over the coming years?
Yeah, why do I think that is? So when I moved over here 2.5 years ago, the first thing I noticed was that it was difficult for me to get a credit card. And Michaela will know this from the US. We usually have 2 or 3 credit cards there. And the credit card providers actually, they incentivize you with these great perk programs. And so I guess anecdotally, my thinking was that it's just so much more acceptable in the US to use credit on a personal basis. And so that's kind of then shifted over into the commercial side or the business side. I did quickly look this up yesterday. In UK, 20% of card transactions happen on a credit card, 80% on a debit card. And in the US, that's actually more like 33 to 40% of card transactions happen on a credit card. So I do think it is consumers to use credit in the US. and that probably does then move over into the business side. I think also, look, using leverage with has been around for 30, 35 years. I think, SVB's been around doing this for what, Michaela, maybe 30 years?
Yeah, 35-ish.
So it's just more, it's more well known in the US. And I think that's how things will change here. The likes of SVB moving over to Europe and educating the market, the likes of CLP setting up funds here, bringing over that kind of North American style of doing venture debt and setting up shop here and doing it. And then ingenuity in credit financing and using leverage and the likes of forward advances. I think over time, Europeans and people in the UK will be more willing to accept using credit or using leverage as part of their capital stack.
Yeah, I completely agree with Daniel. I think it also comes down a lot to just education. So as Daniel said, in the US, there's institutions that have just been doing this a lot longer. And so the comfort of using venture debt and having seen how it works through downturns and how lenders react through downturns, there's just a greater degree of comfort with what it means for your business and how your business will use it as part of its solution going forward and long term. I think over here, I've been in the UK for about almost 2 years now, and I already sense and see kind of the change. In the presentation, I talked about, and that's the biggest difference between the US and the UK. The timing on when we receive a lot of these introductions and a lot of these opportunities is when the liquidity is tighter, and it's that need to have versus you want to have it. It's a flexible tool for your business to use. And it's more of a bridge solution that we see over here versus, an upfront runway extension. I think in the US, it's used as truly upfront runway extension where you raise a round of equity, you go and receive a round of, a portion of debt, and it's much more methodical in that way. And so I think we're seeing the tides change here where people are bringing debt on sooner, but it just comes down to education. So sessions like this are super helpful where we can just explain what the product is. And then I know myself and I'm sure Daniel are free to connect or look at any companies that maybe you think are on the cusp, but you're just not sure and want to talk through it. We can always have those conversations. A lot of our job is just that education piece on explaining how it's going to work and what potential solutions might be.
Yeah, I don't have a lot to add there. I think, it's a much more mature market in the US. The funds have been doing it for a lot longer, have strong links into the VCs, and the entrepreneurs are more familiar with the product. So all in all, it just means uptake is a lot higher.
Yeah, makes sense. So I'm sure many of us on the topic of tight liquidity have seen that demand for short-term liquidity is increasing and can see that venture debt can provide financing to companies that have delayed financing rounds. So on the topic of everyone's favorite topic, COVID, what is the role of venture debt during and post-COVID-19? Are venture debt investors dispersing faster during this period, or are they waiting for uncertainty to decrease before investing?
Yeah. You go, Daniel.
Sorry. Yeah, so you've thrown me off here, Michaela. At CLP, we think we're at the start of a long-term recession. And so we encouraged all of our portfolio companies to go out and get 18 to 24 months of runway, or just runway at the end of 2021. And so, I do think for good companies that have good underlying growth, and maybe want a bit of flexibility around when they raise equity, given that the equity markets are it's a bit difficult to see where valuations will be, say, in the fall and winter. If you have good companies that we're going to raise in the fall, raise in the winter, or early 2021, and they just want more flexibility around when they have to go out and do that raise, then I think it's a good time to start looking at debt as an alternative capital source. And then, does the disbursement rates increase? I don't know, Michaela, I'd be interested to hear your thoughts on this. I think at CLP, we we're trying to be more selective around the investments that we make. And so what does that mean? Companies in travel, companies in hospitality, companies in retail, or selling to, they have customers in those verticals, will be more challenging for us. At the same time, there are businesses that with COVID, they're going to just benefit from this kind of catalyzed move towards digitalization. So I think that we'll probably see, with the combination of those two factors, I think we'll probably just see the same amount, at least at CLP, we'll look to do the same amount of deals if we can as we were before.
Yeah, I think there's a few components to it where each sector is affected, but they're all affected in different ways. So I think consumers taking a harder hit than enterprise or fintech. Consumer-based fintechs are taking a harder hit than some of our, businesses selling into large enterprises. But I think everyone is seeing longer sales cycles as a result of working from home. And so a lot of our conversations center around our businesses shifting quite quickly to protecting the bottom line against the top line, because so much is unknown. And I think similar to Daniel, we're taking an approach that very much so this could be a long-term kind of downside for everyone. But some of the trends that we're seeing just out of March and April are fairly positive. And so how do we kind of hold that conservative view, but also appreciate the continued growth that we're seeing from a lot of these businesses? And I think investors are struggling with that too, and what businesses should continue to burn at a similar profile versus pulling back on those expenses. The kind of reaction on the government side with the furlough scheme and different protection plans has been really incredible. So I think that has, versus other downturns, been really additive to businesses. The conversations we're having with VCs is really, we want to see a business that has about 18 months of runway, because regardless of what happens for a business traction or growth wise right now, unless they have turned a corner as a result of COVID, where it's up to their business, for the most part, valuations make it so that it doesn't make sense to raise right now, because we're seeing that market correction that I'm sure there's a lot of opinions out there on whether or not it was a long time coming. And I think a lot of people are okay with seeing some of that, but as a result, there's going to be a delay in when people want to raise. And so that's part of it too. On SVB's side, for our existing clients, we did a venture debt deferral agreement. So basically for all of our companies, it was an opt-in scheme without any cost, where you could defer your principal payments for 6 months. So we are trying to step up and help the venture clients, because a lot of these government schemes outside of furlough are more catered towards the cash flow positive companies. And so I think we're really trying to solve for this venture space and how things look for the venture companies. And a lot of it is unknown. So it's being able to react to the situations. And it all comes down to the partnership with the VCs. We really appreciate transparency. We've been doing, portfolio run-throughs and trying to figure out, again, which companies are going to need more support and which companies is it COVID related or business related, because that's two very different conversations in terms of what support is needed. I think we're hearing that for purely COVID related, investors are happy to put interim funding in. For business related, that's a very different conversation. And it really depends on the syndicate, how much has been invested to date, and what the exit opportunities look like.
Yeah, and so it's from our side, we were in the happy position of being pretty much brand new as COVID hit, so we didn't have a big existing loan book, which was kind of a nice place to be. I think the big thing is the impact has been very varied across different sectors, right? Travel, fashion has been hit pretty hard, events, things like that, not good spaces. And in fact, we had conversations with clients in those spaces, and when you're being repaid as a percentage of revenue, and revenue has a potential to crash, it's not going to work. On the other hand, what we are seeing is there are a bunch of sectors, household goods, gaming, ed tech, that are seeing real tailwinds. But the thing is, even those sectors that are seeing tailwinds, the VC market is is borderline closed at the moment. People are very unwilling to make new investments until we get a bit more of a sense of what's happening with valuations and the correction. So that means that we have companies that are seeing some real tailwinds. Cost to acquire customers is dropping a lot, but they're struggling to take advantage of it for lack of availability to capital. So we're finding it quite a good time now to support some of those companies.
Great. And so to relate to all our VC and startup attendees, I know you've touched on this point a little bit before, but to make it really clear, when for you is the most optimal time for startups to start thinking about raising venture debt? So are there any specific metrics or business models or anything else that you really look out for?
Yeah, I think for CLP, you need to have raised an institutional round of equity. You need to at least show good product traction. So for me, that's usually $2 to $3 million, euros, pounds in revenues. Clear proof points that the sales and marketing machine works. And so I've kind of always described this as you feel like you have product market fit. You've started to have the foundations of a good sales and marketing machine. You've got the processes in place where you can go and hire someone, bring them in, give them a playbook, and they can step in and ramp quickly, and the business is really ready to scale. I think that's the best time for our capital to be used. And what do we look at? We look at all the same financial and SaaS metrics that you would. We look at market size. We look at how the product differentiates versus competitors. We look at the management team. So it's not that much different than the way that you would assess a business as well.
Yeah, it's the exact same thing for us. We're very similar to CLP in that respect and how we look at things. It's really just getting an understanding for the business, knowing what some of those KPIs are, what CAC is, what LTV is, and it does change sector to sector. So, we have a dedicated life science group. That business model is very different in terms of when you raise equity and what markers you have for success. It's not necessarily revenue. And so each team we have takes a very tailored approach to the type of business model it is and how we look at when it makes sense. But generally that first institutional round is the first marker for us to get into a business with venture debt. Because again, it all goes back to those repayment sources. And until you've raised an institutional round, you don't really have that future equity as a potential repayment source for venture debt.
And we can go a bit earlier. Ultimately the kind of core requirements we're asking for: minimum 6 months of trading history, 10,000 a month of revenue. But the key thing for growth capital is it makes sense when you know that the growth works, when you can spend it on customer acquisition and know that it is going to be driving enough revenue to repay the percentage fee. And really what the company should be thinking is the next level down from that is, will the unit economics work even with a small flat fee on top? At the minute, because we're early, we're maxing out at 50K advances, so we're best suited to seed or early seed stage companies, but that's going to be scaling up quite quickly. So over time we'll move later in the life of companies as well.
Mm-hmm. And for all three of you, what are your thoughts on providing debt to operational businesses or asset-heavy businesses? Is that something you're keen on or not so much?
What asset-heavy meaning lots of inventory, meaning machinery and equipment? That's sort of the asset-heavy? Or for us, when we say asset-heavy, we just think of very techy, lots of IP type of business.
So I meant the former, or even, because we play in the prop tech space, ones that have real estate assets as opposed to being more of a SaaS.
Yeah, so we've looked at the real estate space, and we've looked at a lot of there were a lot of businesses that were helping consumers to fund their purchases of homes. And so some of the assets or the security might be the real estate behind that. We've looked at that. I would say that we've not invested yet. And so if I look broadly across the portfolio, it tends to err on the side of asset-like businesses more so than asset-heavy businesses.
Yeah, at SVB, so I'd say on the prop tech side, I have two deals that are actually going through quite recently that are more on the software side of prop tech, and they do have assets, but those are typically housed in an SPV structure where it's outside of the primary operating company. SVB is building out a warehousing team. We have one in the States. We have someone who joined us here this past year, and she's building out in the UK. I'd say venture debt at more of a growth stage with the right controls can sometimes be useful in getting your feet off the ground, where you have, you know, a couple data points to point to then pursue a warehousing asset-based line of credit and move things into an SPV. But I think really for some of those prop tech businesses, we see them pursue that more kind of sophisticated style of lending outside of venture debt, which we use more for the actual operational business and the runway extension.
And we're fairly agnostic to the nature of the business in terms of how asset heavy it is. Realistically, you know, where we make sense is where the repayment on customer acquisition cost is fairly quick, and obviously it has to be below 6 months, so it's not going to make sense. I'm not sure that would be the case for some of the asset-heavy businesses. And then the other thing is for asset-heavy businesses, presumably they have access to other sources of capital secured against the assets, which might be more efficient there.
Yeah, that makes sense. And then, so what are some of the traps that you think VCs can fall into? So what are they usually surprised about when dealing with venture debt, and what are the biggest things they should keep in mind?
I think probably one of the biggest is using debt to try to extend runway when a company is still figuring out product market fit, or there's still some risk in their go-to-market. You should really think about this as we're trying to leverage the existing growth of the business. So there's a business that's figured out product market fit, go-to-market's working, and it's growing really well, and we just want to leverage that growth. We just want to push off the time when they have to go and raise the next round. So it's almost like you should put debt behind things, behind investments that just build enterprise value, rather than using it to just generally figure things out or generally fund a burn.
I think the big thing I would recommend is view the lender as a partner, and think about the fact that you have a full portfolio of companies. And so having someone who knows how you react and know how you step up for your business, or are transparent when you don't think it's the right time to step up for a business, and using them as a partner and talking through that and making your decisions, but then keeping them involved, I think is helpful for the long-term relationship, because as more portfolio companies that you have want to access debt, it's really important that that lender knows how you react, because again, it all comes down to that future equity. And if a round is delayed or something happens, the knowledge of how that investor reacts in the good and the bad times is so core to how any lender at the venture stage is looking at these facilities and thinking about the syndicate behind the company.
And I think growth capital is kind of new enough in the UK that VCs don't really have much of a thought of it one way or another, frankly. But I think the key thing is just becoming aware of it. And I think, you know, there's potentially great synergies with VC, because ultimately forward advances isn't going to pay for a company hiring a developer or anything like that. It just doesn't work in the kind of cash repayment side. What it can do is get more bang for the buck for the equity financing by just enabling a company to spend more on customer acquisition, grow a bit faster, and go into the next round in a stronger position. So it's really just becoming more aware of it is the thing.
I see, yeah. And then from the side of a VC, what do you think are, and I know Michaela covered it in her presentation, but the most important term to be negotiated? So someone in the questions asked if it was normal having an equity debt swap option, for example.
One of the most important terms to be negotiated. I think it comes down to the structure ultimately. You want to make sure that you are putting in place a structure that really helps the business. And again, it goes back to my point of, you know, figure out what your milestone is. What are you using this capital for? What is it getting the business to? Make sure you know that up front, and then work with the lender to put in place a structure that allows the business not only to get there, but to get there with a bit of buffer and maybe even get past that, so that they ensure, one, that they can get to that next round and raise it successfully. But if everything goes according to plan, maybe they get even further past that, and you just raise a larger round or at a better valuation, or maybe you've got a growth rate where you can bring in a better investor than you had originally thought.
Yeah, I think for the VCs, completely echo the milestone comment. And then I think where VCs can add a lot of value is you work with people across the space and you have more touch points than your founders are going to have. So being an advocate for them on what relationships you really value in the market, and who you trust, can add a lot of value to a founder who just doesn't know where to go to, who to talk to, what the right debt number is. And then just being someone that they can soundboard off of. We talked about quantum, and I think sometimes the quantum is a really exciting part of the conversation. But then when we do look at the terms and the pricing and the use cases, does that quantum make sense? And I think the VC can be really additive to a founder in identifying the right partner and the right amount of debt, because you know the use case and you're so tied into what those business milestones are.
Yeah, and so on the growth capital side, there's not much to be negotiated. It's basically the fee and the repayment percentage. So nice and easy, and just playing with those. I think on the venture debt side, from a VC point of view, to my mind, it's often around understanding how it fits in the future fundraising and making sure that it's going to optimize fundraisings down the line by enabling growth that's going to get you a better place. And it's not going to become a problem in those fundraisers by drawing cash away or being too large for a future fundraise to support.
Mm-hmm. And final question from me. How can we, as VCs, best help startups looking at taking on venture debt?
Yeah, be an advisor there for your companies on relationships, on experience working with a certain lender, and don't just focus on the terms of the deal in terms of the pricing or getting the cheapest deal. I think I said this earlier. It's a 3 to 4 year relationship that you start with someone. You want to find the best partner with the best rapport, and someone that you feel like you can trust in, that they're going to be good to work with, not only when they're first engaging with you and the company has cash and you're putting the deal in place, but also as things get tougher. That's where you really see what people are like. And so how will you know that? If it's your first time working with them, you may not. So I'd encourage you all, go out and do your own diligence beforehand. Start building relationships with the likes of Luke and Michaela and myself early, so that when it does come time to start making those introductions, you can make an introduction to a CEO and actually say and mean, I know this person. I've gotten to know them over time. They're good to work with. And then I can encourage, as you do bring leverage into your portfolio, start building a repository of terms so that you understand, what terms are available and when lenders will move on things and why lenders will move on things. And then you can be a really good sounding board for your founder when they come back and say, CLP wasn't on this, or CLP has this pricing. Then you can say, well, actually, I understand why, and here's why it is.
Yeah, I echo completely everything that Daniel said. The thing I would underscore would be the timing. So we talked about part of the reason venture debt isn't as common over here is just the lack of education. Now that we've had this session and there's a greater understanding of venture debt, if you are a part of a round and you think it makes sense and there's the right use case prompting to that company to pursue venture debt option, founders have so much going on that a lot of times it might just not be the front of mind thing for them when they have a lot of liquidity on the balance sheet. So encouraging them to pursue this early is a really great kind of benefit that a VC has because you are so tied into that recent liquidity event.
Yeah, and I think one of the big advantages VCs have is the the fact that they are a step removed and the fact that they're seeing a lot of different companies, so they have a bit more context. So I think from a founder's point of view, either they are so focused on running a business that they're not even considering optimizing around financing, or they're so focused around runway that they'll charge after any source of finance available. And I think helping founders to understand when is the right time and what are the right options is really valuable, because not every option is right at all times.
Luke, did you freeze there? Possibly. It sounded like a good end of sentence anyway. So thank you so much. I'm just going to open it up to a few questions submitted. So one of them being, Michaela, in emerging or immature venture ecosystems where venture debt is not common, where would you suggest we refer to for best practices? So terms, pricing, other resources.
Yeah, it depends on the region that you're thinking of. So if it is somewhere in Europe, I honestly would just encourage to reach out to myself, and I can connect you with someone on our team in the right sector, depending on where that company sits. But we do look at deals across Europe. The kind of caveat there is just, what does that company look like? What does that ecosystem look like? Do they have the chance to scale there? But there are opportunities for debt financing across Europe. We, from London, cover most of Europe for the debt side. We also have a team in Germany that covers all of Germany. So there are debt opportunities available. I'd say on the terms side, in the US, you'll see a lot of banks and debt funds competing on the venture debt side. In the UK and in Europe, there's just a lot less players. I think SVB is one of the few institutional banks offering it. There's some banks who are dabbling in it, but it's not their full focus. And then there's debt funds like CLP that are another really great option. And so it's a smaller ecosystem, but there's still a lot of players involved. So just, yeah, as Daniel mentioned, do your diligence on that area, but then feel free to reach out to either one of us and just consider, you know, is there an opportunity there? Are we able to do something there? And we can talk through terms with you.
And this one's from Catherine to Luke. Thanks for sharing. Can you confirm, do you rank ahead of other investors? And does the rev share put stress on margins, which can negatively impact additional funding rounds later on?
So because we take a rev share, kind of almost by definition, yes, we would rank ahead of most of the people because we just taking cash right at the top. In terms of margins, you know, I think it's up to the startup to reflect that in a way that is true, because I wouldn't view it as part of the cost of the goods sold. It's much more a cost of financing, right? So the way I would be representing that on the accounts is right at the bottom, and therefore wouldn't be hitting any margins other than EBITDA, or potentially even that. So yeah, I don't think it needs make financing more difficult, but we would be repaid as a priority.
Mm-hmm. And whoever wants to take this one, how do you respond to companies who do approach you for more of a bridge financing rather than a runway extension as part of a round? Any takers?
So we're terrible for bridge financing. It would be a really bad idea. You know, you get a month of runway and have to pay it back very quickly. So yeah, I don't think I'm a good person to answer this.
Michaela, I saw you jumping in. So
I was on mute, sorry. For us, it's highly dependent on the investor syndicate. Again, everything is so relationship based with these types of facilities that if it's a syndicate that we know really well and we've seen how they've reacted in similar situations, we potentially can get comfortable with that. I would use those as the exceptions, not the rule. Bridge financing overall is super tricky for any lender just because the execution risk is so high. And we talked about pricing with these facilities. They're already fairly well priced with warrants and everything. And that's when you bring on venture debt early. If you're bringing it on for a bridge round, the price is going to be pretty heavy. You may be able to backlay some of that cost with a success fee or otherwise, but I think most of the time I've seen that an interim equity round actually makes more sense. It's the right business decision versus bringing on some sort of debt vehicle for a short period of time.
Mm-hmm.
Yeah, And oh, sorry, and where we've done financing, it's it's easier where it's an existing portfolio company versus a new portfolio coming in. It's also easier where the company has a term sheet for its next equity round, and it just needs capital to get through the closing of that versus, we haven't started our fundraising round. We're going to be going out soon, but we need another 3-4 months to get that closed. That's a much more difficult conversation to have with any lender. So think about those things as your portfolio companies come to you to start talking about bridge financing.
Good tips. So this one was actually the very first question of the session, and it's quite broad, but Sheila would love to hear more about how Daniel scaled his portfolio.
Well, I'll let Michaela give her thoughts on scaling her portfolio as well. But how did I scale my portfolio? So yeah, I moved over 2.5 years ago, as I said, and look, I guess it comes from two things. One, it just comes from getting 1 or 2 deals done. You get a few deals done, and you are able to work with a founder, and you're able to work with the members of the board, so the investors on the board. And you can start to build out a name for what that relationship looks like. And then inevitably, most of the companies we fund, all of the companies we fund operate in a realm of uncertainty. And most of them don't hit their plan. I think everyone watching this will be nodding their head that yes, our companies don't hit their plan. So just being flexible when things don't go according to plan is what cements that relationship and then builds the name for your firm or yourself in the market. And so it just, over time of doing deals, going through tougher situations, you build that name, and then you get referred into more companies. And then I think just, it's a fairly small ecosystem here in the UK and Europe, at least when I came over. It's definitely growing, but it's smaller in comparison to San Francisco where I was. And I think everyone's very open here. Everyone's very willing to help each other and send deals back and forth. And so, it was the benefit of doing some deals and building relationships. It was also the benefit of a really good open ecosystem, people being willing to share.
On my side, I've been privileged just that SVB has been around for 35 plus years. And so the groundwork was laid long before I got here in terms of the market and the reputation and the brand. And so the privilege of just being a part of that affords a lot of opportunity in terms of inbound requests and inbound introductions. We have, as I mentioned, a global funds team. So they work with VCs. So we have this really tight ecosystem of VCs that we bank and funds that we bank. And it's a very kind of connected, as Daniel said, small ecosystem. So everyone's sharing information, where a VC who's familiar with our team might ask, because they have a portfolio company that they think is right for debt, for an introduction to our team. And so we see a lot of inbound requests. At the bank, I sit on the credit side. My counterpart, Craig Fox, sits on the relationship side, and that's done very purposefully, where he has really deep sector expertise and knowledge in fintech. And so he's really well connected throughout the market. And what he's able to do is really be a sounding board for founders and someone who can go out and connect with people. And then we work in tandem on the debt side. So again, I kind of have the privilege of having a lot of things come in through me versus necessarily having to go out and source a lot. But it works really nicely for us, and it is a small space relatively. So we are able to have, a solid book with the inbound interest that comes in.
Fantastic. And the very last one from the crowd, do all of you guys always meet the companies in person, considering the scale of your portfolio, or especially now considering COVID?
I'll let Luke take that one. As a VC and now a lender, I'd like to hear his thoughts on that.
On the VC side, we have historically met all of them. I think we've got a couple going through now that potentially we might not meet. On the forward advances side, we've never met one of the companies we've made an advance to yet because of the timing. Everything has been done virtually. Now these are smaller advances, so the level of risk feels more manageable.
And then from our side, we haven't made a virtual investment yet. I hope to get a term sheet out today, which will be our first term sheet that we've sent out, having not met a company. The process is different. Where previously I could have gotten to a term sheet in 2 weeks, I think it's taking us 3, maybe even a little bit longer now as we think about and build in new steps to perfect our virtual term sheet process. And it just means more diligence around the founders. It means maybe more reference calls, maybe customer calls earlier. We've just closed our second fund and we have capital to deploy, and we think there are good opportunities out there for us. So we are trying to figure out a way to continue to make investments, even if it means doing them fully virtually. Although I think we're all hoping that we can get back to being out and meeting founders in person.
Yeah, we're a bank, so on the account opening side, there is just the element from a compliance perspective of seeing someone on site. And I'll be honest, I'm not tied into enough on the account opening side to know how they have navigated that during these times. But I know we're doing a lot to accommodate the current circumstances. On my side, we're happy to do the Zoom meetings. We always at least have a meeting with the founder, the CEO, the CFO as a part of our diligence process, but naturally those tend to be the people who are running that process anyway, especially on the earlier side where there's probably not a fully built out finance team that they might be working with to complete the debt, or someone who's assigned solely to the debt. So we typically, I would say, engage with either the founder or CEO very early on. If they've brought a CFO on, we'll engage with them. But for us, the Zoom meetings have been really great. I'd say I have almost more FaceTime, because outside of that first meeting, typically pre-COVID, where you would have it in person and then you would just have diligence calls, now all of our meetings are kind of video calls where we're able to connect and run through the term sheet and have really quick conversations. So interested to see how things evolve out of COVID. And I imagine that we'll probably have more touch points like this moving forward, where we're able to have these really quick meetings.
Well, that pretty much wraps everything up. Thank you so much to all of you. You've been so amazingly informative. Michaela, thank you for the session. Daniel, best of luck with your term sheet today. Luke, best of luck with forward advances, and I hope to talk to you all soon.
Thank you.
Thanks,
Thank you.
Thanks. Bye.
Bye now.